Hey, what's up? I'm Russ, and I've been wanting to do a video on Microsoft for a little while now. They just released earnings, which were pretty good as usual, and there's been some interesting developments with them as well that I think is going to make them a behemoth, and they're coming for that king of the gaming hill, which is what we're going to focus on and what we're going to talk about. So if you want to, click on over to dapperdividends.com. I got my bridge portfolio. You can check it out there. And without further ado, let's talk some dividends.
Giddy up.
So yeah, Microsoft just released their Q2 2022 earnings, and as usual, they beat estimates. Just massive numbers. They had a revenue of $51.7 billion, which beat the analyst expectations of $50.9 billion for the quarter, and an earnings per share of $2.48, which beat analysts' expectations of $2.31. I just checked that out, that their revenue of $51.7 billion was 20% up year over year. Net income, $18.8 billion, up 21% year over year. And the cloud revenues, which is my focus of this video, was $22.1 billion, or up 32% year over year. Azure and cloud services grew 46%, which was down from 50% growth of quarter one. And as of today, and after hours after their earnings drop, they were down about 5% to $273, and they're down almost 22% from their all-time high, which was mid-November of 2021. Now I'm thinking it looks like Microsoft is probably being dragged down by the entire technology sector, which is indeed down almost 15% year to date. And I love to look for deals within that sinking sector like I did when the financials were sinking, and I found one of my favorite financial dividend stocks, which is Prudential, ticker PRU.
Well, nice work, Inspector Find It.
So why am I so excited about potentially buying Microsoft within a sinking sector? Well, it's because of the aforementioned Azure, which is their cloud services platform, and the powerful possibilities that it could bring. On January 18th of 2022, Microsoft announced they'll be buying Activision-Blizzard, ticker ATVI, for $95 per share in an all-cash transaction valued at $68.7 billion. Now, Activision has big hits like Call of Duty, World of Warcraft, Candy Crush, and Diablo, not to mention the games that ZeniMax, which Microsoft bought recently for $7.5 billion, brings to the table in titles like Elder Scrolls, Doom, Fallout, and Wolfenstein. Now, one of the most played titles on the Sony PlayStation is indeed Call of Duty, which has helped Sony to the #1 gaming revenue spot worldwide with $25 billion in 2021. But I don't think Microsoft is going to allow that to continue, and they want to overtake that #1 spot, and I think they're going to likely keep all the Activision titles away. And with a combined 2021 gaming revenue of $19.7 billion, we could see a boost to Microsoft and a decline of revenue for Sony. Microsoft says there's about 3 billion gamers worldwide, and they expect that number to jump to 4.5 billion gamers by the year 2030.
There's lots of them?
Lots and lots of them.
Hold on here.
And I think that Microsoft is trying to become the Netflix of video games with their Game Pass subscription service, which is currently in beta, which has 3 tiers, and the top tier does cost only $14.99 a month. Now, gamers are able to download or stream over 100 games, including new releases from the cloud, straight to their Xbox, PC, smartphone, tablet, TV, Mac, or Chromebook, which allows gamers to play whenever they want, whatever they want, on any device they want, all without having to buy an expensive console. Even better yet, Microsoft Game Pass users have access to titles from Electronic Arts, Ubisoft. We'll say Ubisoft. And if you know how to say it, leave a comment below, and take 2 interactive games, which I do hold their stock, which has the famous or infamous title, however you want to look at it, of Grand Theft Auto. And Microsoft has the intention to keep some future games exclusive to the Xbox and PC, such as the upcoming Bethesda game, Starfield. Very interesting what Microsoft's trying to do, but I'm a dividend growth investor, and that's that's what we talk about here on the channel, primarily is dividend growth stocks. So let's check out and take a peek under the hood to see if Microsoft is indeed a dividend growth stock. And we see that Microsoft's current dividend yield is only 0.86%, which is about 39% below its 5-year average, and their forward PE of 30.8 is about 16% above their 5-year average. Their dividend is incredibly safe with a free cash flow payout ratio of only 29% and a very healthy $8.02 of free cash flow per share. And that dividend is growing at a very fast clip, 13% per year the last 10 years, with 11 years growth and 15 years of uninterrupted dividend payments. And SimplySafeDividends.com, rightfully so, gives Microsoft a dividend safety score of 99, which is very safe. Now, that was a quick surface snapshot of Microsoft. Their fundamentals are rock solid, but the fundamentals don't tell us when to buy, they tell us what to buy. So we know we'd want to buy Microsoft, but is now the right time to buy Microsoft? And when I look at the weekly chart, I see support at $280 a share. So we'll see if that holds. And the next support level, if that doesn't hold, is at about $240 a share. Currently, this is the cheapest that Microsoft has been since October of 2021. And if you, like I, think that Microsoft is just going to keep expanding that empire, then baby, now might not be a bad time to at least get half a position, buy a few shares, buy whatever you need to buy to get your foot in the door if you don't have it in the door already, because I think Microsoft is going places, and I'm super excited to see if they can indeed knock Sony out of that #1 gaming revenue spot in the coming years ahead, provided that the Activision-Blizzard deal is allowed to go through. And in the event of a market crash, Microsoft is one of my top priorities. I currently only hold 2 little itty-bitty teeny tiny shares in our retirement account, and I really would like to expand that, and I hope they do come down in price because I'm selfish and I want more bang for my buck, because as you remember, when the price goes lower, the dividend yield goes higher, and that's what we like, is those high and safe yields.
Some low risk, high yield.
Now, because of cloud gaming, streaming, autonomous driving, the Internet of Things, the forthcoming metaverse on top of talk and text, I'm super excited about the big 3 telecoms as well, which are in order: Verizon, AT&T, and T-Mobile. Now, these companies provide something that is critically needed, which is data, and faster data. That's the way the world's going. We're all addicted to our phones. I have a cell phone addiction. People are addicted to the streaming, to games, to their TV, to the internet, to texting. And baby, you know what? This is the place you want to be, with the companies that are providing that stream of data that we are all just craving and jonesing for. So those 3 companies are going to have cash coming in the door for years to come. Now, I personally don't invest in T-Mobile. We are invested in Verizon and AT&T. And on a side note, one thing they say is, an investor, you can disagree with this, and let us know if you disagree in the comments below, but where it's at is addictive properties. If you have a product that is addictive, then that is pretty good chance that you're going to have a sticky product and a lot of revenue coming in. And addictive doesn't just mean those sin stocks. But I digress. I love AT&T and Verizon. And on top of these reasons, I gave a few more reasons right here in this video. If you'd like to check it out, help yourself. Thanks for watching, and I will talk to you there.